Good evening. Jochen, I have to correct you. I'm not always right. In fact, if you talk to my wife, she would say I'm always wrong, especially when it comes to the dishwasher and stuff like that. Okay. So, good evening, and it's a great pleasure being here again. Lots of happy faces, lots of familiar faces. We saw each other exactly 1 year ago when the price of gold was trading at 2,700. Now we're at 4,000. So it's been a good year for us. And it's also been an interesting year. And who was here last year when I presented? Who remembers my little road trip that I had with our dear host, Patrick Michaels? So there's always the conference, the Precious Metal Summit in Beaver Creek, and then on Monday, they're starting the Denver Gold Show in Colorado Springs. And in between, we're also always doing a road trip. So last year, Patrick said, let's do a road trip. Let's take an Alpine Pass. We've got a nice car. The problem was we took the wrong turn. So it took us like 5 to 6 hours. We didn't have any cell phone reception. We didn't have any GPS. And if you know Patrick Michaels, he's always really positive. He's always optimistic, smiling. And I think I saw him for the very first time really nervous. So that was a near-death experience that we had together and was kind of a bond. So in hindsight, I really enjoy looking back to that moment. And this year, together with Florian Grummes, we said, let's do a road trip again. And we went axe throwing. So not axe like Eier, but axe. And Patrick is a really good axe thrower. So when we see each other together with Florian, we always greet ourselves like this, yeah. So, but thank you very much, Patrick. Thank you, Andrew. Thank you to Zuri-Invest for the invitation, for putting together this wonderful evening. Let's briefly talk about gold. We all know that since 1971, the world's been in a big monetary experiment, the fiat era. But we've seen that one monetary asset has stood apart. And the number that you have to remember is 9.4. 9.4 is the CAGR, the compound annual growth rate of the price of gold from 1971 to 2025. So I would say a quite decent performance. But still, what does the financial establishment tell you? What do the CFAs, the asset managers trained to worship modern portfolio tell you? They still tell you that gold is a pet rock, that gold is a barbarous relic. Because their models, their religion, if you will, modern portfolio theory, it says that markets are always perfectly efficient. So all prices are always perfectly fine. Everything is discounted. But let's make an experiment. Ask those experts a few simple questions. Ask them about the 5,000-year track record of fiat currencies or of gold. Ask them about inflation cycles. Ask them about the Austrian School of Economics, and you will get blank stares. And then ask them the simplest but most fundamental question of all. Look them right in the eye and ask them, what is money? And you'll probably get more blank stares. And this is a phenomenon that we see in the Western world. If you talk to people from Turkey, from India, from high inflation countries in general, they will have a much better understanding of what money actually is. And this brings us to the heart of this problem that we're facing today, that the old investment playbook is breaking down. Because the classic 60-40 portfolio, it basically rests on one bet, that bonds always hedge equities. But now, as we're facing inflation all over the globe, as we're facing this new inflationary reality, bonds are no longer a stabilizer for your portfolio. They've become a dead weight. They are dragging portfolios lower as inflation risks still are vastly ignored. So that negative correlation between stocks and bonds that we've been taught to take for granted over the last couple of years, it's actually the exception. It's not the rule. Because the data is clear, we crunched the numbers. Over the last 100 years, stocks and bonds have actually moved together 70% of the time. So why did the 60-40 portfolio last for the few decades? Because it was an anomaly, the so-called Great Moderation, a world of constantly falling inflation rates. But ladies and gentlemen, that world is over. Now the big question is, where is the future demand for gold coming from? I think it's not coming from the equity side. From my point of view, equities and gold aren't opponents. From my point of view, it will come from the largest market, which is the fixed income market, 160 trillion. And if even small breadcrumbs from this large cake in fixed income, 160 trillion, move into the direction of gold, this is going to have a big, big impact. And this is starting to begin now. So this is why we, in our 2024 report, we said you'll have to have a new 60-40 portfolio. We said it should be 45% stocks, 15% bonds, 15% what we call safe haven gold, 10% performance gold, 10% commodities, and 5% Bitcoin. So as you can see here, gold plays a double role. There's first of all safe haven gold. That's physical gold stored in safe jurisdictions with minimal counterparty risk. There's no need for active timing. You just buy it, you hold it. It simply sits in your portfolio as a strategic monetary reserve. And you've probably got no idea how many people, how many institutions are approaching us and asking us, what is actually the best jurisdiction for saving our gold? So this has become a very, very important topic. But the thing about safe haven gold is, I hope that I can inherit it to my kids, to my grandkids. But there is no need for active timing. But then there's performance gold. That's silver plus gold and silver equities. This part of the portfolio, from my point of view, has to be actively managed because we know that volatility is high and that leverage can cut both ways. So safe haven gold provides stability and performance gold adds momentum and leverage to your portfolio. And together, they can be transformational, as we've seen over the last couple of months. Now, it's not only Incrementum coming out with this view. Actually, Morgan Stanley, a company which is slightly larger than Incrementum, they came out with the 60-20-20 portfolio. They said 60% equities, 20% bonds, and 20% gold. So, ladies and gentlemen, this is happening. Larger companies on Wall Street are finally realizing that inflation risks will continue to be in the market and that gold is an excellent portfolio diversifier. But let's briefly talk about the current setup in gold. Last year, at that time of the year, as I've said, gold was trading at 2,700, silver was at $32. Well, I remember in October, I got up in the morning, I looked at the screens, gold was up 2-3%, new all-time highs. We all got used to that. But to some degree, we all kind of knew it's not gonna last forever. So, on 10th of October, we had gold at 4,000. 7th of November, gold at 4,000. But it feels like in the gold industry, there's an enormous amount of pessimism. And I've never seen sentiment switching from overly bullish to pretty pessimistic in such a short time frame. Now, we remember October 21st. Gold taught us a lesson in statistics, a move of 5.7%. Now, that's a 4.5 sigma event, as it's called in statistics. In a normal world, that's actually impossible. It would only happen every 240,000 trading days. That's a pretty long time. But in real life, actually, it happened 35 times since the year 1971. So it happens. So the message is, gold isn't really a low volatility asset. And we all know that the move in October, it was driven by FOMO, fear of missing out. It was driven by momentum chasers. And I think those short-term players and the weak hands, they've been cleared out over the last couple of weeks. Now, what does it mean going forward? Statistically, we crunch the numbers. After such days, high volatility, usually calmer days are ahead. So now is not the time to panic. Now is the time to do your homework. Now is the time to prudently build allocations. But I don't see really that it's the end of the correction yet. And we all know that the volatility in miners is brutal. So as you can see here on this chart, we showed the volatility of mining stocks in the last two bull markets, in the current bull market. Look at the y-axis. We're looking at 60%, 70% drawdowns as a normal part of the bull run. It happened in the 70s, it happened in the 2000s. And now we've seen a 20% drawdown in the GDX. So miners, as you know, are gold on steroids. They will test your conviction, ladies and gentlemen. But this volatility is the flip side of their explosive high beta potential. Or as Rick Rule once said, miners are gold on steroids. When you buy gold, you're buying insurance. When you buy a gold miner, you're buying a leveraged speculation on that insurance. And I think that perfectly sums it up. Now, from my point of view, as I've said, we haven't seen the end of this correction. I mean, days like this, they're trying to challenge my opinion. But based on our models, we would say the next couple of weeks, probably until Christmas, it's going to be some sort of a choppy sideways trading. So from my point of view, 3,850, something like that, is a target that I can see coming over the next couple of weeks. But again, this is a healthy correction. It's a pullback. It's definitely not the end of this bull market. Now let's briefly talk about the key drivers of this bull market. It's first of all monetary excess, it's geopolitical shifts, and it's systemic distrust. Or as a Wall Street bank recently said, the 3 Ds: debasement, de-dollarization, and diversification. I think it's interesting that now the term debasement trade is so big in financial media, and they're talking about it now, and it's like the next big thing. From my point of view, the debasement trade actually began in 1971. But anyways, it is the momentum that we're seeing in markets. Now, the first driver is monetary excess. As we know, gold does really well when governments cannot resist the printing press. On average, since 1971, M2, that's a monetary aggregate, grows by 7.4% per year. But as you can see on this chart, actually, I would like to show it with the laser pointer, but I learned that laser pointers are forbidden in Switzerland. So, yeah, it's very, very dangerous to handle them, it seems. So, as you see on this chart, we've seen some sort of stagnation when it comes to the money supply over the last couple of years. But now the money supply is rising again. And my friend Larry Lepard, he wrote a good book called The Big Print, and he says the price of gold is already discounting, it's already smelling this big print that's going to happen. Have a look at the monetary growth. It's mainly driven by China now. Nobody follows the growth numbers coming out of China. Few people saw the big news today that China is officially restarting quantitative easing. I thought it was really big news. So the majority of the monetary growth globally is now coming from China. And from my point of view, we'll see it in the Western world as well. And we all know what's going to happen when the next crisis happens. Central bankers will try to put out the fire. We just saw the end of quantitative tightening in the United States. Last 2 weeks, the balance sheet of the Federal Reserve grew by 150 billion. So there will be another round of quantitative easing. And as Peter Schiff once said, there will be more rounds of quantitative easing than Rocky movies. So we can expect more QE. Now, going forward to the second driver, obviously geopolitical shifts. We all know the data. We all know that the US still acts as the world's payment back office. So every dollar transaction flows through the system of the United States. But China, Russia, and others are now building rails to actually bypass Washington. And for 3 years in a row, we've actually seen central banks buying more than 1,000 tons of gold. That's a third of annual gold production. That's significant. And in the first half of 2025, central banks bought 483 tons. Third quarter, I think 283 tons. So we're right on track for another year of more than 1,000 tons of purchases. And it will continue. Just read the central bank gold survey. It shows that a record 43% of all central banks are planning to boost their own holdings. So Poland, China, Russia, India, they're not diversifying. They're actually remonetizing gold. Now, what does this chart tell us? It shows central bank holdings and, on the other hand, US debt held by foreign central banks. And it's a very famous chart that Tavi Costa put together a while ago. And you can see that gold's share of international reserves just rose to 28%, which is the highest in 30 years. Now, everybody is talking about de-dollarization. From my point of view, de-euroization comes first. And we're already seeing that. So gold just officially took the second place. Gold is now the second largest monetary reserve, and it took over from the euro. Now, who of you was here last year when I presented? Okay, quite a few. You might remember I've got this tradition of coming up with weird analogies, mostly from the world of sports. Last year, I introduced you to the world of professional wrestling. So who remembers the heel turn? Yeah? So the heel turn is actually in wrestling when the bad boy, the bad guy, becomes the good guy. And this is the best example. Who's that? The Rock, Dwayne Johnson. So before he became a Hollywood star and actor, he started as a wrestler. And he's probably not the very best actor. It's like a little bit like the Arnold Schwarzenegger of this generation. But he was a great wrestler. And he started as the bad guy. But then the audience said, this guy is so good, so interesting, so good looking perhaps. We want him to be the good guy. So this is a heel turn. And this is exactly what we're seeing in central bank behavior. Nobody cared about gold during the Great Moderation. For 40 years, central banks have basically been selling gold. But now we're seeing this heel turn. The bad boy gold becomes the good guy. Central bankers all over the world, especially in emerging markets, they're signaling a rediscovery of gold as a neutral monetary reserve asset. And the third major driver is systemic distrust. We all know the Hemingway saying of how he went bankrupt, gradually, then suddenly. And this is what's happening to trust. It's eroding, it's collapsing gradually, then suddenly. We're seeing it in science, we're seeing it in politics, we're seeing it in media, we're seeing it in society. And now we're seeing it in the gold market itself. So as trust in the system, in the plumbing of the system wanes, physical gold is surging. And as you can see here, COMEX gold deliveries are going through the roof. So this demand for physical gold, for real stuff, is revealing the fragile truth. London vaults are draining, COMEX deliveries are rising, metal is moving. So investors are sending a very clear signal. We want real bullion, not paper claims. And this is a sign of distrust in our system. Now the big question is, where are we in this cycle? Dow theory shows that in every trend, there's 3 phases. You've got the accumulation phase, the contrarian phase. Then you've got the public participation phase, and then you've got the distribution phase, the mania phase. Now, ladies and gentlemen, gold is not a contrarian asset anymore. That's pretty clear. But I think now we are like really in this public participation phase. And here's like the green arrow when we put out our last In Gold We Trust report in May 2025. Since then, quite a lot of things happened. Actually, Jamie Dimon says that gold could easily go to 5,000 or even 10,000. Goldman said gold could go to 4,900 in 2026. If you followed on Bloomberg the commodity price forecasts previously, all those analysts basically expected a sideways move and then the price of gold to go lower. So this is a sign of a bull market. I worked as an analyst for 7 years. You don't want to be the big contrarian in a big bank because it's about career risk. So Wall Street is now finally realizing, okay, perhaps gold is an interesting thing, which is a sign of this stage of the bull market that we're in. But to use the big short analogy, and the leitmotif of this year's report was the big short, I think we're somewhere in 2007 when Michael Burry, he found the first few people on Wall Street who were actually starting to believe his thesis, his very bold, his very contrarian thesis. We're somewhere in that stage. Now, despite growing interest in gold, institutional allocations are still pretty small. That's a study by UBS for family offices, above 100 million assets under management. So family offices currently hold only 2% of their assets in gold and precious metals. 2% gold, that's like, and 1% in commodities. Art and antiques is like 1%, infrastructure is 1%. If you have a look at allocations to private equity, to real estate, or even cash, they're significantly higher. So 2%, that's not a hedge, that's actually pocket change for a family office. And you know what I see in my daily business? I talk to lots of institutional clients, and often they call me and they say, we're considering selling gold now. We've made this big move now, but very few are still considering buying gold at these elevated prices, which I think is quite telling that we're not at the end of the road. Another great chart by Bank of America, inflows since the year 2020. Actually, 2.7 trillion inflows to stocks, 4.5 trillion to cash, 2.1 to bonds, 0.1 trillion, so 100 billion to gold. I calculated the number, 100 billion, that's like 2% of the market cap of NVIDIA at the moment. So I know for the gold market, it sounds like a huge number, but it's all relative. So from my point of view, this is not a sign that we're trading in a bubble yet. Now, let's briefly talk about the valuation of gold. Is gold expensive? It depends. If you compare it to oil, if you measure it in commodities, gold is actually pretty expensive. But I wouldn't actually value it in things that we consume, but rather in things that we can print. Or we can compare it to other asset classes, like equities, for example. Now, if we compare the market cap of gold to the market cap of US equities, the S&P 500, currently, gold's market cap is just 38% of the market cap of equities. That's exactly the long-term median since the year 1925. Now I ask you, ladies and gentlemen, do big bull markets usually end at median values? No, they end at extremes. And you can see in 2011, you can see in 1980 or the 1930s, gold was valued actually at 160% of the valuation of equities, for example. And now one of my favorite charts, the so-called shadow gold price. Who knows the shadow gold price? Nobody, okay. So that's actually the question. Where would gold be? How much would gold be worth if the whole monetary base were backed by gold? So at the moment, if it would be 25%, price of gold would have to be 5,400. At a 40% backing of our monetary base, 8,600. And 100% backing, that's 21,000. Now, this is not a forecast, but it's rather a mirror, and it's showing us two different things. First of all, that the monetary expansion over the last couple of years has been massive. And secondly, that gold as a monetary asset remains deeply undervalued. And the interesting thing, ladies and gentlemen, is history rhymes. And I tried to read less like news and daily noise and more history, monetary history. And if you read history, you will see that twice in the last century, actually in the 1940s and at the beginning of 1980, the market value of official gold reserves covered more than 100% of the US monetary base. So there seems to be a pattern. Roughly every 40 years, the gold coverage has surged to parity. So if it happened before, why can't it happen again? Especially if you closely listen what this gentleman is saying. Who's that? Scott Bessent, Treasury Secretary. He's on record calling himself a gold bug. His by far largest private position is gold. And he said he wants to be a part of a Bretton Woods realignment. And then there's Stephen Mirren. Who's Stephen Mirren? He's a former senior advisor to the Treasury and now the chairman of the Council of Economic Advisors. He's basically the most influential guy when it comes to the economy and advisory for Donald Trump in the administration. He's now, since August 2025, he's temporarily also in the Federal Reserve's Board of Governors. He's the only one who's always dissenting. He says, we have to lower by 50 basis points. And he wrote one of the most fascinating papers that I've read over the last couple of years. It's a user's guide to restructuring the global trading system. If you haven't read it, read it. It's not easy. It's pretty complex. I read it 4 times. I still don't get everything, but this is exactly the playbook that the Trump administration is working off. So the takeaway is simple. The new Treasury Secretary and the president's top economic advisor, they're aligned. And gold plays a major role in their plans. Now let's briefly talk about what I call performance gold, because one of the main takeaways of this year's In Gold We Trust report was the first half of the bull market, that's gold. But in the second part of the bull market, this is where you should be overweight performance gold, silver and gold and silver mining equities. Now, again, I'm always doing sports analogies. Who's following cycling here? Just one person. Okay, 2. So what kind of sports do you do? In the morning, somebody said drinking. And I said, you're Canadian or Australian? And he said, no, I'm German. Then I said, you have quite a lot of reasons to drink. So cycling, I couldn't care less about cycling until quite recently. Who knows Tadej Pogačar? He's like the superstar in cycling. He's like what Patrick Mahomes is in American football, or in our football and soccer. It would be Yamin Yamal, for example. So he's like a young superstar dominating this sport for the next couple of years. And I learned quite a lot about cycling when I watched this show on Netflix called Tour de France Unchanged. Because cycling may look like a solo sport, but it's actually a team sport. So you've got different roles in cycling. There are the so-called domestiques. They shield the leader from wind, they fetch bottles, they close the gaps, they set the pace. Then you've got the specialists. Those are the climbers and the sprinters. They've got well-defined roles. And then you've got the road captains. They plan the strategic moves and they manage risk real time. So one rider crosses the line first, but the team wins the race. Now, a while ago at the Tour de France, Pogačar, he lost against his arch rival, Jonas Vingegaard. That's like Federer losing against Djokovic or Nadal. It really hurt. So 2 years later, he came back to the Haute-Atacama, which is in the French mountains, the French Pyrenees. This is really steep up there, 14 kilometers uphill, 1 vertical kilometer. And Pogačar returned determined. Team on the front, pace rising, then the launch, the sudden attack.
It looks like it's the final kilometer of the climb.
Audio?
Vingegaard can't go. Vingegaard cannot respond, and Pogačar attacks. Now the world champion puts in a hammer blow, and Vingegaard cannot respond in any way.
Vingegaard looks behind. It looks always just a bad moment, but he's not totally exploded yet.
So yeah, this is basically what I've been saying.
It looks like it's the final kilometer of the climb.
Vingegaard can't go. Vingegaard cannot respond, and Pogačar attacks. Now the world champion puts in a hammer blow, and Vingegaard cannot respond in any way.
Vingegaard looks behind. It looks always just a bad moment, but he's not totally exploded yet.
So it's hard to grasp actually what he did. That's 445 watts of power. You cannot imagine this amount of power that he's putting in. About 60% of 1 horsepower. He flew up that mountain 28 kilometers an hour. And after this attack, the race was transformed. He won the Tour de France. Now, you may ask yourself, how the hell is that connected to gold? From my point of view, that's exactly where we are with gold. Safe haven gold has been the domestique carrying us through pandemics, through wars, through deficits. But now the leadership shifts. Now it's time for performance gold to shine. So like Pogačar on this moment of the race, we've entered a new phase. Now, gold and silver miners have started to outperform this year, finally. And you can see it on this chart. This is a relative chart showing actually the performance of gold, silver, the HUY, the Gold Bucks Index, and the Bloomberg Commodities Index versus the S&P 500. We're living in a relative world. So from a relative basis, we're seeing that gold has started outperforming the S&P already a while ago. Now silver basically is coming out of the wind, taking that momentum. And now finally gold mining stocks and silver mining stocks are catching up. The only thing that hasn't really moved yet, that's commodities. And I think that the risk reward in the commodity space is terrific, especially if you have a look at the charts. We're seeing lots of consolidation patterns, lots of breakouts quite recently. So this is the Otakam moment that we're seeing. Performance gold is launching an epic attack. Now let's briefly talk about performance gold. Silver. As we all know, silver is up 67% year to date. I often said it's basically my highest conviction. We all know that the major driver for silver is actually a 140% increase for silver in photovoltaics over the last decade, which has led to 5 consecutive years of supply deficits, nearly 800 million ounces gone. But what's holding back silver at the moment is investment demand. We haven't really seen much investment demand coming into the silver market. I think this is going to get started at some point, especially when people say, well, gold actually had a pretty decent run, but look at silver. It's trading at the same levels like in 2011 or in 1980. And as the old technical saying goes, there is no such thing as a triple top. And with today's move in silver, we're seeing how explosive that is. So once investment demand really kicks into the tiny silver market, this is going to be the perfect storm. Now we know the gold-silver ratio is currently trading at 82. The long-term median since 1970 of the gold-silver ratio is 60. The long-term median since the year 1900 is 52. So you can see on a relative basis, silver is extremely undervalued versus gold. And you can also see that at secular peaks of gold, for example, in 1980 or in 2011, the gold-silver ratio was significantly lower. Now let's talk about the gold-silver ratio and talk about the leverage of silver. If the gold-silver ratio actually goes to its historical mean at roughly current prices, it would have to go to 65 at our 4,900 price target. Price of silver, just at the median value, would have to go to 82. If we reach our long-term inflationary target and the median value, it's a silver price of 148. Now let's do, just for the sake of it, $8,900 gold and a gold-silver ratio of 10. It's fairly easy to calculate. Glenn, what's the number? 890. So how does that sound to you? What does that to your sensitivity deck? Probably going to calculate that. So it's not a forecast, but can we rule out a gold-silver ratio of 10? We've seen it in history. So let's briefly talk about the miners. What you can see here is, again, a relative chart. GDX versus gold, and then on top, large cap gold miners versus junior cap gold miners. It is showing you that large cap gold miners have just started to put in some relative strength versus gold, and that junior miners have quite recently put in some relative strength versus the large caps. But this is like the normal behavior that you see over the course of a bull market, more risk appetite. And I think we'll meet somewhere in the middle for that chart going forward in that bull market. Now, what's interesting, ladies and gentlemen, is gold and silver miners have ripped, but money is still actually leaving. Look at this chart. Those are the outflows and the inflows into the GDX and the GDXJ. So actually in 2024, when mining stocks have underperformed the price of gold big time, we've seen outflows of 2.3%. But this year, after terrific performance of gold, we're still seeing outflows. We've seen outflows of 3.9 billion into GDX and GDXJ. So ask yourself, who is selling into that strength? And who's left to buy when flows turn? So if prices rose while capital exited, what's going to happen when capital finally comes back? So the conclusion is, ladies and gentlemen, miners are underowned, they're misunderstood, and they're disbelieved. That's not how a bull market in gold usually ends. Bull markets end in euphoria, not in redemptions. I'm already kind of coming to an end. We're primarily asset managers. Most people know us for putting out the In Gold We Trust report, but I founded this asset management company 12 years ago. We're still a boutique, but it's going tremendously well. And now the big question for us as asset allocators is, how do we actually time the market? How do we judge when we're seeing the end of this bull market? There are obviously many ways to judge the finish line. Fundamentals, technical signals, gut feeling, sentiment, you name it. But our conviction is a monetary approach, a monetary quantitative approach, which is based on scenarios, is probably the most robust framework. Now, we came out in 2020 saying that our base case forecast for gold is $4,800. We weren't taken serious, we were ridiculed, a little bit like Michael Burry was when he started with his thesis. Now, we're right on track, but actually we're now on track for our inflationary scenario. So we said, if we're seeing inflation or actually stagflation becoming a real driver in this decade, then we're seeing prices of 8,900 by the end of this decade. Now, who believes that the price of gold can go to 8,900 by the end of this decade? Just Jochen, Jessica, yeah, Florian. Very few people, which is a good sign from a contrarian point of view, I would say. But actually, 8,900 sounds like a big, big number. But from here to 2030, that's a 16.8% CAGR. So the price of gold would have to rise 16.8% every year until the end of 2030, the year 2030, and then we're at 8,900. I think that's pretty realistic, actually. Now, how do we manage mining stocks? We launched a new fund, the Active Gold Fund, 2 years ago, and we said mining stocks are one of the most compelling, one of the most interesting, but also one of the most demanding and complex asset classes. And our approach is a very active one. So we've got a signal, and the signal switched to offensive in December 2023, and we took basically the full amount of this bull market, 160%. But on October 10th, the signal switched to neutral. So since then, we've raised cash, and we're now holding 25 to 30% cash in our portfolio. So don't get me wrong. We don't say that the mining stocks are at the peak. We just took some profits. We didn't hit the brake. We just took, our foot a little bit off the gas pedal. But usually, this signal is moving from neutral to bullish over the time frame of a couple of weeks, 2 or 3 months. So that would put us like December, January, something like that. So my take on the current gold market is the following. Hold on to your strategic positions. Do your homework. Focus on your high convictions positions. Reduce high beta. Get rid of those momentum stocks where I saw many people that sold me inverse 10-baggers during the previous bull market. Those people, those promoters are back again. So be cautious. Buy quality, like the companies that we've seen today, for example. So going forward, my take is this is just a pause. This is a healthy correction that we're seeing, even though, this price action today is really convincing. But my take again is we'll see some sort of a sideways pattern or a continuation of the correction over the next couple of weeks. Now, as I've said, the leitmotif of this year's report was the Big Short. Now, what do we learn from the Big Short? Success is not about spotting what others miss. It's also about knowing when to step aside. Steve Eisman sold before Lehman collapsed. And this gentleman, Michael Burry, you know what he did quite recently? His by far largest position in his fund, I think it's 60% of his portfolio, is puts on Nvidia. Pretty interesting. Michael Burry, he closed his fund after $2 billion in profits. So my message to you, ladies and gentlemen, to the gold community, to the silver community, to the mining family, let's enjoy the bull market, this generational opportunity. Let's ride this bull market. Let's enjoy what we're seeing, this momentum finally, this sentiment that is now shifting. We've been through a brutal bear market. Let's make some money. But don't get carried away, ladies and gentlemen. Don't be greedy. You don't have to hold forever. You won't be selling at the exact top. And try to recognize the final stage just before the music stops. And when that moment comes, we'll be here to help you with the timing. Thank you very much for your attention. Thank you.